Accountants and bookkeepers of Australia, good morning. My name is Lee Davidson and I'm the General Manager here at Finance House Group, a specialist finance broking offering for you as accounting professionals of Australia. Today I'm joined by Lachlan Spence, our Senior Finance Broker, who is here to help me explain to you everything that you've ever wanted to know about accountants' declarations. Lachlan, good morning.
Good morning everyone.
Good morning. Our topic today that we're going to cover off with you is in and around accountants' declarations and how we can help you guide your way through what is becoming more and more of a minefield in terms of how professional bodies are advising you on one hand what to do, and brokers and indeed clients are going to be looking for different things from you, giving you a bit of a conflict as the trusted advisor. So today, what we're going to do is talk you through alternative lending solutions and how we can maybe help you find an alternative to signing off and exposing your business and exposing your practice by way of accountants' declarations. And then we're going to have a look through some of the accountants' declarations that you may well be asked to sign off on. We're going to call that the good, the bad and the ugly, but we aim to give you some expertise and some guidance in and around what you can and what you can't do should you wish to or consider signing off. And then we're going to give you a bit of a summary and then hopefully come up with some tips and suggestions for you. So let's get into our presentation for you today. So what are the alternatives to signing off an accountant's declaration? Well, the slide in front of you has three main options. And what I wanted to do today is to pick out expertise in the room's brain on what these options were. So, Lachlan, other than actually signing off on the accountant's declaration, which does give us a bit of exposure with some of those bodies, which we'll touch upon in a minute, one of the options that we've got up on the slide there is a no-doc option. Tell our viewers today what that means and what the positives and the negatives are of no-doc.
So no-doc options are provided by lenders, traditionally private funders that operate sort of outside of the NCCP or non-code loans. In essence, they're direct asset lenders, so lend to a commercial entity, so a proprietary limited or a commercial entity, directly to the asset. Now, pros of these traditionally there's next to no income verification or assessment outside of sort of know your client and anti-money laundering checks. So it can be quite a fast approval procedure and procedure to settlement or proceeding to settlement, and they can extract the access to equity can be quite quick. So no limitations or very little limitations as far as cash out and things like that, and disbursements to other creditors. So where they are good is if clients need to access equity to consolidate debts, both the lender paying the creditors directly, but also the client controlling them. So it may be high amounts of creditors or suppliers in the business that they need to clear, other personal debts and sort of things across the board that may be prohibitive to a more traditional lender. They're ultimately the positives, so the speed at which you can get approval and things like that. The negatives or the drawbacks and the balance up of these sorts of lenders is generally the cost. So because the verification and the primary security is only to the asset with very little verification of the customer, cost is on a risk basis. So it's generally considered slightly higher risk and therefore higher market costs. And that usually falls back to the private funder requiring a certain return on their investment that they then need to have, and then the lender on lends that back out of their warehouse. So fees and things like that can be expensive, but they definitely have their place. They're a short-term option, traditionally 1 to 3 year terms. Usually the interest is prepaid or capitalised, unless there's a way of proving serviceability. And that can usually give clients the opportunity to have a little bit of breathing room with cash flow by relying on the equity. Ultimately, the balance up of that is that your peak debt does increase, and that's going to be a consideration.
Cost for risk, cost for risk. And the purpose of the presentation today is to give you alternatives to signing off on an accountant's declaration, which exposes your business and exposes your practice. So today's about options. So it certainly seems like the no-doc option has a place. Now, that's not the case for all clients. Some clients may be closer to a mainstream option than those that are requiring a private funder. Our viewers today might not be aware of some of the ways that they can have an alternative to an accountant's declaration in what we in the industry for finance broking call alternative doc or alt doc for short. Tell our viewers some of the ways that an accountant could look at those options without signing off on a declaration.
So an accountant's declaration isn't the be-all and end-all of alternative documentation lending or specialist lending. Traditionally, it's a combination of 2 or 3 items: 6 months of VASs, business bank statements, or an accountant's deck. So depending on how the accountant's declaration is written, where the accountant wants to sit, what their relationship and experience is with the customer, oftentimes the VASs and the business bank statements kind of stack up just as well as the accountant's declaration. And obviously there's not sort of any more increased heightened exposure from a liability perspective, which gives the accountant a little bit more comfort. So they definitely have their place. They're closer to a more traditional term. And if you compare the alt doc offering to the no doc offering, the no doc offering realistically kicks the can down the road. It's solving an issue or jumping a hurdle now, but that hurdle is still there in 12 or 36 months down the line. Alternative or alt doc lending, usually it's we can get in, organise an approval with a lender that still has your traditional 30-year term, and we can sort of progress back through with good conduct every 12 months to go back up their tiers to a more closer to a full doc lend.
Fantastic. So we've got 2 ends of the spectrum, no doc and then alt doc, if you like. And then what we can also sometimes hear from accountants is that actually, this client's really close. This client's really close to having turned things around. And, they may well be in a second-tier lender or a specialist boutique lender where they've had to sort of go into to repay ATO debt or something like that. And, we're getting closer to that stage where we can get them back to full doc. So doing nothing is sometimes the right way to go. How do you work with an accountant at that point who might be looking to refinance, to take advantage of better rates or a market situation that's arisen? How do you work with them to sometimes say, hold on a minute, let's put the brakes on and wait for full doc? How do you do that?
Critically, you have to involve the client and the accountant, and obviously the broker in the transaction, and weigh up the pros and cons of waiting. Sometimes, the client this week, the discussion was for proceeding now versus in 3 weeks when the financials are going to be complete and we're able to proceed based on a full doc application, your saving is going to be in the vicinity of 1 to 1.5% interest, which is massive when you look at the peak debt and the term of the loan. So the difference between waiting can be a huge cost saving, but it's also a really important conversation to have in the sort of ongoing management and forecasting of how the business or the clients are performing. And so that's able to look at certain metrics such as interim numbers and things like that, depending on where you are in the financial year, to forecast ahead the parameters that we need to be able to service a full doc application and how we're going to meet those and what systems are going to be put in place to meet those. And so that really ties quite nicely back into the advisory piece with our accountants, because we're holding the clients in soft hands and guiding them through a journey with not only their lending, but their business operations as well. And that puts them back into that lending cycle where every 2 to 3 years, when we want to look at refinancing to make sure that the premium points of the market, new to bank rates and things and such, that we can specify the financials and financial data to support those applications, whilst remaining tax efficient and cost efficient for the other part years of that period.
Fantastic. So there you have it. There's 3 different types of alternatives that you've got to signing off on accountants' declarations. Now, why did we put this presentation together today? Well, the professional bodies out there, namely the CPA, are currently sort of talking around in the press about you being aware of the risks and all of the consequences that could occur if you sign off on an accountant's declaration and the lend goes bad. Society is definitely becoming more litigious. We know that for a fact. Now, there is a chance that you could, by signing off on a declaration, be drawn into a court case with a big lender who's got lots of money to go after you for signing off, and that's what your professional bodies are making you aware of from a risk perspective. Now, business is about managing your risk, and you have a responsibility to your client. You may well have a client that's been a 20 to 30 year client that just doesn't have their financials done at this point in time, and for whatever reason, they may be looking to lend. It could be a new acquisition, it could be to restructure, to be able to look at some, or paying out some ATO debt. So there could be a commercial decision that you need to make over the risk factor of signing off. So what we wanted to do was to show you some of the declarations, and hoping that they come through okay, but the purpose of these slides is to say, if you have a declaration that you're given, be it from a broker, from a client, or if you're one of our regular referrers that we work with, get in touch with us and we'll help you go through the minefield that some of these lenders will put you through by way of a declaration. There's a few on the screen here. So we have some from the likes of Liberty, which is a very long-winded form that we have here. We've got 2 interesting ones from some of the lenders, or one of the lenders called MKM Capital. They have an accountant's declaration for you with financials involved, but they also have a version which doesn't demonstrate financials. No different to rates, no different to terms. Have you seen the differences? If not, we're here again to give you that guidance and that expertise to be able to help you make the right decision about what's best for your client. Now, what we also know is that some of these lenders will also allow you to adapt the form that they provide. In certain situations, it's a no-go. They won't let you adapt it, and as soon as you go to edit it, it's a no-go. However, some of the lenders on here will actually allow you to make edits to the form, and providing the form doesn't fundamentally change, and I'll use their words that they've repeated to me, providing the form doesn't fundamentally change, you can actually edit some of the words on the form to demonstrate or to articulate the fact that you're the accountant, you're not the credit manager. Okay? Now that bit's really, really important to be able to put into some of these declarations. And our favourite declaration, which is the one that's on screen now, very much says that towards the bottom of this form and in the declaration. And having spoken to Red Z's head of product, that's the conversation that we've had, is that we want our accountants to sign off because some of these lenders work with and do amazing things for self-employed customers. But they also understand that you're their trusted advisor, you're not their credit department. So the point that we're making here is that if you're faced with a client who's giving you a declaration to sign, or if we're coming to you with a declaration to sign from Finance House Group, there are going to be some things that we can do to help you mitigate risk. There will be some other options that we can discuss by way of lending options that Lachlan's kindly demonstrated and discussed with us today. It won't always be about sign the declaration, because we also know through working with the number of accountants that we work with is that the CPA and your professional bodies are advising you not to do this. So we will look at options with you, okay? As being your finance division and sitting in your practice with you, we're here to come up with those options for you. So, in summary, what we've covered off today is that the accountant's declaration is a source of lending. It has a place. However, there is a risk versus commercial reality aspect of everything that we do. If you don't feel comfortable in signing off with an accountant's declaration because you adhere to the CPA's advice fully, or it's a client that might not be fully known to you as much as you would like to be able to sign off, discuss with us options and alternatives that can exist, because not everything affects pricing or policy in a hugely negative way. AllDoc is a great way to be able to come up with alternatives here at a fraction of the cost more, and maybe not even increasing the rate. Now, on AllDoc lending, the lenders will generally look for two forms of income to confirm servicing. As Lockie said, VAT statements, business bank statements, so no declaration required from you. That's what we wanted to cover off with you today, Accountants of Australia. So, if today has resonated with you as one of our viewers, and you don't have your own finance department, or you don't feel that you're working closely enough with a broker who you may refer to, get in touch with us at Finance House Group. We regularly work with accountants all over the country to look at ways to help your clients get the best independent advice and the best rates available in the market. We look forward to hearing from you. And likewise, if today has resonated and you do want a conversation about creating a relationship with Finance House to help your clients with residential lending, equipment finance and commercial lending, we'd love to hear from you. Thank you ever so much for your time. Lachlan, thank you for joining us today. We look forward to seeing you again on FHG TV next week.
Thanks, everyone.